There is news, and there's what it means. The news last week is that the US Treasuries auction was the worst we've seen in over a decade, causing Moody's agency to downgrade the US credit rating. This is the news. You've probably heard that. But what does this mean for the United States, for the dollar, and for our money and our investments? Now, don't worry, I'm going to make this complex story easy to understand so you know exactly what's going on and how to prepare. So in this video, I want to break down how the Treasury auction works, why it was so bad, what trend we're on, and what happens if it gets worse and if it fails. Why the end game could be in the next 90 days unless the Fed and the Treasury pull out another magic trick. This is a big move, so let's go. All right, real fast, if you're new to the channel, my name is Mark Moss. I make these videos to change the way you think about money because it's hard to understand what's going on. So I try to take these complex subjects and make them easy to understand, and not just easy to understand, but so what? Make them actionable. And so let's dig right in. Last week, Friday, the markets were shook hard when the US Treasury auction struggled. Now, some might even say they came close to failing. When we saw Moody's, a credit reporting agency, they actually downgraded the US government's credit to negative, from stable to negative, citing large fiscal deficits and a decline in debt affordability. Now, this is really big news, so let's just jump in. Now, just real quick, shout out to my good friend and my partner in the Bitcoin Opportunity Fund. I'm talking about James Lavish. He writes a paper called The Informationist, and he wrote about this. I got a lot of the content from that. I'm gonna link to it in the show note down below if you wanna read even deeper into this. All right, so you already know. The US government is spending like a drunken sailor, and everyone's waking up to the reality that the appetite for others to buy the US government debt, to buy the demand, is just not there. It's not big enough to eat up all the supply the Treasury needs to offload. And so last week, the Treasury announced that the amount of the borrowing for the auction would be smaller than most people thought it'd be. It was actually going to be $76 billion less than they had borrowed the previous quarter. And even more importantly, they announced they would continue to borrow more short-term debt than the longer term. Now, it seems like the Treasury is starting to wake up and realize that the world's becoming deeply concerned about the amount of debt they need to continue to operate. And so then by releasing fake numbers, by releasing the numbers lower than expected, they would hope to squash some of those fears. Now, for some, that game might work. But for you, if you've been watching these videos, if you've been paying attention, then you know that the Fed seems to release one set of numbers, a budget. They make the headlines, they hope to squash the fears, but then quietly they revise it later when they hope no one's watching. But of course, we cover it all the time. But here's a few important things that we can decipher if we read the report. I have a couple things here. So first, the primary dealers, they said, the primary dealers, which are the buyers of last resort, explicitly noted a high degree of uncertainty overall around deficit and growth forecast. So if we decipher this, to what this means is that the Treasury is admitting that the buyers of last resort, admitting the primary dealers are concerned with being stuck with debt. The second point that they said in the report is that they said the Treasury anticipates that one additional quarter of increases to coupon auction sizes will likely be needed beyond the increases announced today. You see what they're saying? The Treasury is basically telling you what I said. They're telling you right there that they're underreporting the amount of debt that they're going to need to issue. And then there was a third point, which is in the report, which is a really big one. And it said, quote, Treasury continues to make significant progress on its plans to implement a regular buyback program in 2024, end quote. That is the telling piece. We talk about how many more tricks do they have up their sleeve, and they're telling us what they have right here. They're telling us that they have another trick up their sleeve, that they want to create a Japanification of the United States, if you will, buying your own debt. Sort of like a snake that would be eating its own tail. Okay, so what actually happened last week, and why was it so bad? And more importantly, what should we be expecting and how should we be positioning for this? Now, we're gonna get to that in a minute, but first, let's dig into some of the numbers so you can understand just how bad this was. All right, so in basic terms, when the Treasury needs to borrow, they sell debt as bonds. Now, these bonds are dated anywhere from months as T-bills all the way up to bonds, which could be up to 30 years. And we can see that the 30-year bond auction went about as bad as it could have. And we can see this in a couple of ways. First, there's something called the bid to cover ratio, BTC, meaning how many bids come in to cover the issuance. It's the supply and demand. Now, this is represented in a number, and this auction was 2.24, which that probably doesn't mean anything to you, but to put it into context, this used to be 2.5 or 2.6, meaning there was more demand than supply. But because foreign demand has been dropping and just, demand overall is dropping, this number has been dropping. And of course, because prices move on supply and demand, if the demand isn't sufficient, then the price has to rise. And that's exactly what we see. This is something, or it creates something called a tail, which means that the actual price that buyers received, they received a better yield or a better interest rate than what the Treasury was actually hoping to pay. Now, for the 30-year bonds, the Treasury was forced to pay a 4.769% yield, which was 5 basis points higher than what they wanted and had signaled in the pre-auction trading. This was the tail. Now, we see tails, regularly in the markets. This is how they work. But normally we see maybe 2 to 3 points, not 5. That's why this is so shocking. It's actually the worst Treasury auction we've seen since 2011. Now, this tail shows us how weak the demand was, and it shows how the government had to basically entice investors with a premium over the market to buy their debt. Now, if we stay on the demand for buying these treasuries just for a minute, because obviously it's important, we can see some very alarming data. We can actually see who's buying this stuff, and we can see how it's trending, and hint, it's not good. Now, the auction results show us who bought the debt, broken down by, first of all, primary dealers. Primary dealers, which again are the banks, they're the buyers of last resort. They're the ones that have to buy it. Then we can see the direct bidders. These are institutional investors and individuals. And then third, we have the indirect bidders. Now, these are the foreign buyers. And what we can see is that over the 3 auctions this year in 2023, the percentages of those 3 buyers has shifted dramatically. So in January, we can see the foreign buyers which are the indirect buyers, the indirect bidders, they purchased about 75% of the debt. The direct bidders took about 16% of the debt, and the primary dealers, the buyers of last resort, had to take up only 9%. Now, if we fast forward to last week, we can see a massive shift in these numbers. Most notably, the foreign buyers, they've dropped from 75% of the debt all the way down to 60%. And the primary dealers, they were forced to jump, the buyers of last resort, had to jump from 9% all the way up to almost 25% of the debt. Now, remember earlier, one of the points is that the Treasury made is that the primary dealers were getting nervous. Now you know why. Now, another thing to point out here is that while I highlight that foreign demand dropped off, they actually bought more in US dollar terms. So while we talk about foreign demand dropping off, they're actually still buying the same or even more in US dollar terms. It's the percentage that's dropping off because the Treasury is just releasing so much more. We can see it went from 13.4 billion up to 14.3 billion. So it's just the percentage of the debt issuance that's dropped. Now, what this tells us is that it's not just a demand problem, right? The demand is still there. They're still buying. It's a supply problem. There's way too much supply for the existing demand that's there. The US government is taking on too much debt. It went from 17.9 to 23.9 billion. So this basically, proverbial hot rock in a hard place that we talk about all the time. We've been talking about for probably at least 2 to 3 years at this point. We call it the debt spiral. Well, that debt spiral, that coil, it continues to tighten. And this is really highlighting the showdown that's coming between the Federal Reserve and the US Treasury. Now, I made a video about that earlier this year. We'll link to it up here, put it in the show notes down below if you want to go watch the showdown between the Fed and the Treasury. But at this point, it's very hard to imagine how the Fed could even possibly continue to raise rates in this environment. How could they possibly raise rates? How could they stick with quantitative tightening right now? Now, the higher for longer rates, they're sending the interest on the debt sky high. So if the Fed wants to continue quantitative tightening, which is basically the Fed selling off the bonds on their books, then they're competing with the Treasury in the markets, right? As I already outlined, there's already too much supply and not enough demand. So if the Treasury is trying to sell debt, there's not enough demand for it. And then the Fed wants to sell it on top of it. Who's going to buy it? That's the problem. Now, if the Fed tries to sell their US Treasuries in the market, it's going to cause a big problem. So what's going to happen? That's the question everybody wants to know. Now, I don't know. I don't have to crystal ball, but here's what I think is likely to happen. Here's a likely scenario. Now, the Fed, I think, is going to be forced to. They have to pull back on their quantitative tightening stance, right? The Treasury is going to continue spending. The Treasury is not going to cut back spending. They're going to continue spending. They're going to continue raising money on the short end of the debt curve. That's in the T-bills. Now, this is going to work for a while, but there's a point it's going to run out. What is that point? Well, we see it in the reverse repo facility. Now, the reverse repo is sort of like this big account that's been moving money into the T-bills, but it's running out of money fast. At the rate we've been going and at the speed that we've been going, we can see this reverse repo could be drained in the next 3 months. In the next 90 days, this could be over. So once that's drained, then what? How does the Treasuries continue to move this? Well, this is where the magic trick up the sleeve comes into play. I think this really kicks this new Treasury program into high gear, which is their bond buying program. They want to get it up and running because, well, someone has to buy their debt. Might as well be them, right? But this is really the only way. If the Treasury needs to keep taking on more debt, which of course they do, and the public and foreign governments don't want it all, which they don't, then either the Treasury is going to have to buy their own debt with some crazy financial tricks, or the Fed is going to fire up the money printer. They're going to start quantitative easing all over again, and we start this whole cycle over again. All right, this is really the only way. The Treasury and the Fed, they're boxed in. They're trying to move within the box, but as soon as the Fed signals a pause or a pivot, then we're going to see the equity markets start running. We're going to see asset prices shoot sky high. We're going to see houses, gold, Bitcoin. It's all going to shoot higher. The Fed can't win. There's no way the Fed can win here. So I expect the Fed to try to walk this tightrope verbally. I expect them to try to hold rates too high for probably too long. That's going to cause the economy to continue to show signs of stress and slow down, probably faster than the Fed wants. The Fed's going to continue holding rates too high for too long, like they've done, just like they held rates too low for too long. The Treasury is going to actively try to manage these rates lower on the long end of the maturity curve. The yield curve that we've been talking about for a long time should uninvert in the next couple of months, and you know that spells disaster. And then I expect the Fed to jump in and blow this thing again sky high. This is pretty much the only way. The timing of how it plays out is what we're unsure of. But I'm positioning myself to take advantage of this in my portfolio. I'm ready for what I believe is going to be the biggest rush to hard assets, to energy-intensive assets that we've seen. It's sort of like a big scam, almost, if you will. We're seeing nations, sovereigns, institutions rushing to hard assets where they're trying to tell us to continue to hold money in US dollar denominated assets. But I'm not falling for it. Are you? It's going to be interesting to see how this plays out. That's what I got. Let me know what you think down below. How do you see this playing out? Who wins, the Fed or the Treasury? My guess, it's going to be the government. Let me know in the comments down below. Give me a thumbs up if you like this video. If you don't, you can give me a thumbs down. That's okay. If you don't like it, that's okay. Just leave me a comment. Tell me why. Subscribe if you're not already subscribed. And that's what I got. All right, to your success. I'm out.